Hey, what's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. You already know, follow the prompter below. Let's get right into it. We're going to talk about where the stock market is going and why it's important for you to be ready to pivot, right? Pivot. And then what I mean by that is not changing your entire plan, but making some adjustments, okay? Because the Fed has made some adjustments. So let's get into some news, and then I'm going to cover some things. It is Weeble Wednesday. Check out Weeble, the link below. Deposit $1, get 6 free stock plus 1 free stock by using my link below. Let's go. And so we already know that September is generally the worst month, right? And it didn't fail I'm sorry, there's a fly that was in here because I left the front door open while moving some stuff. So if y'all see a fly land on my head like Mike Pence, I'm going to keep going. So September was the worst, was a horrible month. And also, too, it was the last week, which was last week, was a horrible week. We know that, right? So here's what I mean by pivoting. Today, oil is down. Oil is actually up. Because OPEC decides to lessen its production. So they're going to reduce its production in oil, causing oil to go up today. But financials are going down even though the Fed is raising interest rates. So traditionally, if the Fed is raising interest rates, then banks should be making more money, meaning your financial stock should be going up. But there has been a pivot, that things are changing. So we have to change with what we change. Okay. Now we have a plan, but we make minor adjustments within our plan. Okay, good people. So that's what I want to talk about today and why it is important. Don't just go off of just stick 100% to your plan that you had, 2 years ago. And what I mean by that is my $5 a day challenge. That's going on for 5 to 10 years, okay? It works. I didn't create it. It just works. And so that you just keep buying. You buy at the top of the market. You buy at the bottom of the market. You buy in the middle of the market. That's why I use Weeble, because it allows you to buy fractional shares. You could set it and forget it. But you could use Robin the Hood. You can use whatever platform that allows you to buy fractional shares, okay? Fidelity allows you to do that too. Leave a comment if you know other ones that do it. But this, you could set it and forget it. Okay. So then the last 2 days actually were green because we were oversold. We were oversold because of the Fed's pivot, meaning the Fed was going more aggressive. He got more and more aggressive as he saw how out of control inflation is. So inflation is the problem. Inflation, inflation, inflation. Okay. So just remember, this coming Friday, we have 8:30, I believe, Eastern time. We have the job numbers coming out. I know there's data like payroll came out today. Let me put my glasses back on. So payroll numbers were slightly up last month. Month over month. So payroll was slightly up, not by much, but the market really didn't react too bad to that. So what'll happen is this week is going to be extremely volatile. We got Friday's job numbers coming. We had 2 green days. And even though, even though we started out red in the pre-markets, these are the weeks where we can start out red and we can actually fight to green at closing bell or flat, and vice versa. For the rest of this week, it's going to be an extremely volatile week. All right. So last week we were oversold, and then we had 2 green days, Monday and Tuesday, to get some of that back. And now reality is kind of setting in. All right. So we'll see what closing bell tells us, but not just closing bell for today, what the rest of this week is going to tell us. Okay. And so just remember those important dates. Also, too, on the 19th, after closing bell, Tesla will be having its earnings. Okay. So let's go into some charts right now. Well, not charts. Let's read some reports. and let's see what's going on and Larry, what does this all mean? Right. So I'll tell you right now that I was showing you a article that said people that generally invest in the stock market, that start investing in a bear market, not a recession, a bear market, usually do well. A recession too, do well after 20%, negative 20% on the S&P, right? So I looked at that number. That number was 3790-ish. Well, we hit it, good people. And I'm still not buying because the Fed pivot, I pivot. OPEC decides to do this, then those are unforeseen. Putin decides to go to war. Those are unforeseen. If he starts ramping up and talking nuclear, those are unforeseen. It's if the party that's in charge decides to start printing more money, those are major game changers. Okay. And so that's why we have to pivot, not change, but just pivot a little bit on our plans. Now, long term, this is what I'm going to continue to say, and I've been saying. We could have a rally this year at the end of the year. I've been saying that all this year. But I believe personally that will be the biggest bear trap ever before the upcoming recession. Now, you could trade that and make great money, meaning you could buy at these lows right now and take profits if the market goes up, November, December. See what I'm saying? So those are not long-term plays for me. Those are swing trades, okay? Those are TQQQ plays. The T is for tall, remember? S is for short. I made that up. That's not what it stands for. But if you want to play the market short term, okay? And then if you see stock that you could get into and get out during the Christmas rally, I'm just giving you guys something to look at or to think about. Now, anything I say is not a suggestion for you to buy, hold, or sell. I'm just trying to assess the data that's coming at us. These are fastballs that are coming, okay? So we looked at this. We saw that OPEC, you see that. 2 million barrels per day. They're slashing oil production by 2 million barrels per day. That's massive, okay? And of course, this is midterms. So the politicians that are in office, I'm just going to stay neutral because I'm an independent, don't like this right now because it makes them look bad on their watch. Okay, so we're going to keep it rolling. And I want to also show you this. This is what I want you guys to see. This is not all gloom and doom. All right, look at this. Markets typically bottom out. See here? Markets typically bottom out and rebound months. I want you guys to remember this. Months before a recession ends. Let me blow that up. See that? That is very important. I'm going to show you this again. This is very important in your long-term investing. Markets typically bottom out and rebound months before the end of a recession. Okay? And so that's what I want you guys to understand in your trading, just like I've been saying. Just because we go into a recession doesn't mean it's going to be a direct correlation in time with the overall stock market. So in your trades, just know that you should be buying during a recession. There's some stock you buy before recession. There's some stock you buy during the recession. But some of you don't want to buy red. I don't understand that because that's what you're supposed to be doing. Okay? Buy the fear, sell the greed. That's what we're doing, good people. So I want you to see this chart. All right? Look at this chart. Sorry about that. Look at this chart, good people. Now I want you to see that this is, let me see if I can blow this up a little bigger so you guys could see it. Look at that. Peak trough decline. So the purple is the decline. Okay. The black is the 1 year. All right. Later after the down, And then the green is 2 years. Okay. So this is what we want you to look at. All right. This is the baseline. This is negative. The black is 1 year after a recession. And this is 2 years after. So here, 2 years later from trough. Okay. So what we want to look at is what is the average, right? The average. Let me put myself in here and we want to average it out. Okay. Let's go down here in the bottom. Okay. We want to average it out. All right. So what we want to do here is, boom, there we go. Sorry about that, good people. Look at this. This is what we want to look at because we don't know what's going to happen this time. You can see the dates down here from the past. All we could do is go by past data. All right. So here we go. This was the last big recession. Listen, down 57%. 1 year later, up 68%. 2 years later, up 93%. But that doesn't mean that that's going to happen this time. Let's look at what the average is. So here you have the average and then you have a median. Okay. The average is negative 29%. See here? And 1 year later, positive 40%. After the recession, 2 years later, 54%. Okay. So the average recession is negative 29%. Okay. The medium is negative 24%. And so this is just a rough of how we could look at what is the median. Now, there's a lot of talk about, okay, is this going to be a hard, long recession or is it going to be a short recession? I don't believe I'm going to be one of the ones that is going to say, I don't believe that this is going to be the worst recession ever. No, because we still have good jobs, which will turn south. And if the home sales have, both feet on the brakes right now, it's not anywhere near 2008, nowhere close. And if we keep good jobs, then the Fed could still, there's a small chance, but he still could have a little bumpy landing, but it won't be that bad. So yes, we are going into a recession. I believe that 100%, but it could be short-lived. I know I don't roll with the herd and everybody's like, it's going to be the worst, but it could be short-lived. Okay. But that's on the Fed. If the Fed goes too aggressive, too long, which he probably will. So he was too late. Now he's going to go too aggressive and he could go for too long. Then that just wipes it all out. Okay. So let me just do this right quick. This is how you got to think about it. My theory is talk to me like I'm 3. So when you go to a car dealer, this is why you have to be willing to pivot. When you go to a car dealer, you go and you sit down, right? And you go, hey, Mr. Car Dealer, I want to buy that car. How much is it? $40,000. Okay, $40,000. Okay, I'm ready to pay for it. I like the car. Yes, but there's shipping and handling. Okay, well, how much is it now? It's $43,000. Okay, let's go with it. Well, we had to pay someone to drive it from the other location to this location. Okay, how much is that now? Oh, it's $45,000. Okay. But we got PMI, SQP, LMNOP taxes too. What are those? Oh, don't worry about it. And that's what we have to put on there. Okay, how much is it now? It's $50,000. Oh, okay. Well, is that all? Well, we got to give you the Under Armour coating and all of that crap. How much is it now? It's $60,000 now. So I'm having fun with it, but that's what's going on with the market. All right. For those of you that said, hey, I thought you said this. We're sitting at the car dealership. They said the price cost this much. But then they got all these hidden fees. So we have to be able to pivot just like sitting at a car dealer, especially a new car dealer with all of those hidden fees. Okay. So I'm going to leave it right there, good people. I just wanted to have a little fun on this day. Listen, we ain't scared. We prepared. And that's what we're going to do. We're going to stay prepared and we're going to stay focused. And last but not least, you all guys already know that click the links below, right? You already know that with Moo, you can deposit $100 and get 15 free stock. You guys already know that, right? So let me go over this one more time really quick. Moo is where we're just cashing up, getting ready for the hard recession. We're already in a recession, okay? That's Moo, okay? So it's better to have, I believe everybody needs 3 portfolios and then 4 with crypto. Then with Webull, and this is Webull Wednesday, that's where we're dollar cost averaging, DCA. Okay, good people. Hey, hopefully this has been a little help. Leave me a comment if it has been. I just wanted to show you guys where we are going. And for those of you that say, hey, well, where are you looking at the S&P now? Short term, anything under 34, but long term into next year, anything under 35. But long term, meaning hard recession next year, 33, 32. And so remember, do your own math. We'll do that. We'll do the math in the next video and go down 29%. Okay. So just take the S&P minus 29%. Instead of the highs of the S&P, I would just start from this year and go from there, good people. All right. Love you guys. We'll see you later. Live, love, laugh, and learn.